Hello everyone, and welcome to today's video. We're going to talk about a topic that often shows up in headlines, the national debt. You've likely heard people say it's too high, or you may have come across debates on how to reduce it. But what is it exactly? How does it work? And why does it matter? Today we'll break down the basics of the national debt in simple terms without taking specific political side. Let's begin with a straightforward definition. The national debt is the total amount of money a government owes to creditors, both external and internal. Think of it like a running tab of money borrowed over time by a national government to fund various activities, programs, and services. Most countries around the world have some level of national debt. In the United States, for example, this debt includes money owed to individuals, corporations, state or local governments, and foreign entities that purchase treasury securities like bonds, notes, and bills. But the concept itself isn't unique to the US, whether we're talking about Japan, Canada, Germany, or any other country. The idea of a national debt is fairly universal. Governments commonly borrow money to meet expenses that exceed their immediate tax revenue. Two terms often get mixed up: national debt and budget deficit. A budget deficit happens when a government spends more in a given year than it receives in revenue, usually from taxes and other fees. The national debt, on the other hand, is a cumulative figure. It's the total amount a government owes after years or decades of borrowing to cover those yearly deficits. So, if you imagine a bathtub filling with water, each year's budget deficit is like a bucket of water added to the tub. The water in the tub is the national debt. As long as there are deficits, more water is added to the tub. If there's a surplus, meaning the government collects more than it spends, water might be taken out of the tub, potentially reducing the debt. Governments borrow money for several reasons. 1. Infrastructure and public services. Large projects like highways, schools, hospitals, and military programs often require upfront capital. Borrowing enables governments to invest in these projects without having to raise taxes drastically in a single year. 2. Economic stimulus. During recessions or economic downturns, governments might increase spending or reduce taxes to stimulate economic growth. This often results in additional borrowing. 3. Unexpected events. Natural disasters, wars, or public health emergencies might force a government to spend more than anticipated. Borrowing can help address these immediate needs. Borrowing isn't necessarily bad or good in itself. It depends on how the funds are used and whether the country can manage the interest payments. When we say the government owes money, who do they owe it to? Generally, creditors include 1. Domestic investors, banks, pension funds, mutual funds, and individual citizens who buy government bonds. 2. Foreign investors, other countries or foreign financial institutions that purchase those same bonds and securities. Or 3. Government agencies or trust funds. In some cases, one part of the government holds debt from another. For example, in the US, certain government-managed trust funds can hold treasury securities. Just like any loan, borrowing money accrues interest. The rate depends on factors like overall economic outlook, the government's creditworthiness, or market demand for bonds. Low interest rates mean the government can borrow at lower cost, which makes servicing the national debt more affordable. High interest rates can make borrowing more expensive, increasing the amount of money a government has to pay just for interest each year. This matters because interest payments come from taxpayer dollars, which could otherwise be used for public programs or tax cuts. Here's where opinion starts to vary. Some say high levels of national debt can hamper economic growth and burden future generations, who might face higher taxes or reduced government services to pay it down. Others argue that as long as the country can manage its interest payment, debt can be a useful tool for growth and investment. In many advanced economies, governments run a debt-to-GDP ratio as a measure of debt's relative size to the economy. GDP, or gross domestic product, is the value of goods and services a country produces. If a country's debt is growing faster than its economy, it might become harder to pay the interest without cutting other spending or raising taxes. In theory, a government could reduce its debt by 1. Running budget surpluses, collecting more taxes than it spends, then using that surplus to pay down the debt. 2. Economic growth. As the economy grows, tax revenues may increase without raising tax rates, potentially reducing the need to borrow. Or 3. Inflation. Rising prices can erode the real value of outstanding debt, making it easier for government to repay its bond with cheaper money over time. However, very few countries aim to fully eliminate the national debt. Instead, they focus on keeping the debt at a level that's sustainable relative to the country's economic output. Here are common misconceptions. All national debt is foreign owned. Not true. A portion is usually held domestically. The government must repay the entire debt soon. Unlike personal loans, government debt is managed continuously over time. Bonds mature, the government pays them off or refinances them by issuing new bonds. Debt always cripples the economy. Not necessarily. Debt can finance beneficial investments like education or infrastructure, which could boost future economic growth. So that's the national debt in a nutshell. Essentially, the total amount of money a government owes, built up over time to fund various programs, projects, emergencies. The debt itself isn't inherently good or bad. It's largely about management, economic conditions, and how borrowed funds are used. If you found this explanation helpful, consider sharing your thoughts in the comments below. Thank you, and remember to keep informed, stay curious, and approach big financial topics with an open mind. Please like, share, and subscribe for more neutral videos. Thank you.